Yeah, even here at the Western Outpost, 20 inches of snow is enough to debilitate the whole city. Volumes were very light, but on the other hand, it's been a very good day for consolidation, especially in the equity markets. You think, the S&Ps are up 1% on the month, up 4% for the year, up 24% since September. And given what happened on Friday with the crisis in Egypt, I think traders were looking more for a follow-through, and once they didn't see it, there was a lot of short covering. So really today, light volumes, but a very good sign, very good technical sign where we just need to consolidate and sit here for a little bit.
Are we talking sort of between 12,100, 12,200 area? That seems to be where the smart money's kind of coalescing.
It seems that way, and it seems like more than that, you have the higher beta group stocks outperforming right now. So that's going to keep the Dow where it is. The S&Ps, on the other hand, 1307 in the cash seems to be a really important number. That was our resistance point the last couple run-ups. And if we sit here, the economic data stays positive, we could easily see 1350 by mid-year. Keep in mind, though, there's a lot of things that could keep that from happening. We have the sovereign debt issue. We have our own issues with municipal bond crisis that could peek its head at any time. But right now, given the economic data is being supported a little bit, 1300 to 1350 seems reasonable for the S&P.
All right, Thursday in Europe, you flagged sovereign debt there. Jean-Claude Trichet, big day for the ECB president. What do markets want to hear him say?
What the markets want to hear is what they want to hear all along, is that Germany is on board, whether they should be or not, whether they'd like to be or not. All the words that have come out of Germany is that they're not on board right now with the consensus thinking. And, quite frankly, I'm not sure I blame them. But if they're not forced to buy sovereign debt, the issue might end up being they might have to take a banking haircut. And a banking haircut, even one that's 5% or 10%, could be disastrous to the near-term economy in Germany.
And what do markets want to hear Ben Bernanke say on the back of Friday's jobs numbers? We got a private survey overnight. We've looked at that one, but really, the market's anticipating strength in the Friday report. If it doesn't come through, what does Bernanke say?
This is interesting because Bernanke on Thursday is actually going to be taking questions, which he doesn't often do right away. And I think what's going to leak out and what the market needs to hear, although they might not be asking for it, is that QE2 will go on till its completion in June, and perhaps even whispering a QE3. Just yesterday, I believe, the United States surpassed China as the largest owner of its own debt. Yeah. But with that said, our economic data doesn't support stopping QE2. Our jobs number isn't nearly what it needs to be. Our housing sector is still, in the trash. And one last thing people aren't talking about is our service sector. Our manufacturing sector is doing well. Our service sector, just like Britain, has not caught up. And so when those three things don't happen, QE2's got to go to completion and perhaps a QE3.
What do you mean by the largest owner of its own debt? How can you buy your own debt?
That's a funny question. So up until just yesterday, China was the largest buyer of our debt, or I think it was like $900 billion. We actually surpassed the $1 trillion mark yesterday, I believe, surpassing both China and Japan, who is in number third owner of our own debt right now. So basically, the U.S. government's controlling its own game by raising the reserve requirements, and that's how they buy the debt. And we're in uncharted waters. The Fed has been doing a very good job, but we are fumbling in the dark right now.
So just shuffle money one to the other and just, hush, hush, wink, wink, all that, she'll be right, to coin an Australian expression. Let's talk, speaking of Australia, Larry, on a serious front, and that is sugar and futures in the pits there. 30-year highs now, mounting concerns about Mother Nature on several continents.
Yeah, especially your continent. Good grief, the cyclone, you have flooding. What a summer it's been for Australia. And sugar, just like a lot of other commodities, are directly affected by weather. I mean, nothing else. And so you can't ration demand for a commodity. You can only ration the supply, and weather, unfortunately, is doing that. So will this be a long-term thing? Let's hope not. But right now, I think it was a 30-year high in the price of sugar. What's going to happen next? What's going to be the next shoe to drop?